Good afternoon and welcome to today's webinar, the 3S, Food, Fuel and Fertiliser, What's Ahead for Aussie Farmers. Thank you for joining us today. My name is Annabelle Johnson and I'm the CEO at New South Wales Farmers. Before we get into the content, just a few quick housekeeping. A recording will be shared if you have registered for this session. If you're experiencing any technical issues, please put in the Q&A function the word technician and we will come to assist you. If you can't find that, it's at the bottom of your screen, and if you can't see it still, it's in the more function. At any time that you want to submit a question, you can do that also by the Q&A panel. That again, it's at the bottom of the screen. We have got a lot of questions to get through because many have come through. So let's get into it. So to begin, I wanted to outline the current situation and what New South Wales Farmers is doing. Farmers are at the heart of food production. The current global unrest is having an impact on the global economy, the local economy, farming communities and your farming businesses. These challenges are front of mind for New South Wales farmers. That's why we've been running a series of webinars to focus on the crisis and get you information about the latest developments so you can understand what it might mean for your operations. Last week we focused on fertiliser, the week before was fuel, and today we're dealing with all three: food, fuel and fertiliser. And of course, we've seen another dramatic twist this morning with a 2-week ceasefire being agreed to between the US and Iran. The US has paused bombing and Iran is committed to reopening the Strait of Hormuz. So what has New South Wales Farmers been doing? We've been hard advocating on your behalf. New South Wales Farmers has been meeting since the crisis started with state Commonwealth ministers and departments, both directly and through the National Farmers Federation. And we've been doing this both on the topics of fuel and fertiliser. On fuel, our priority is addressing the supply shortfalls and barriers that are being experienced in regional communities and for farmers. At the New South Wales level, we've been working through the Energy Emergency Management Centre and which is coordinating across departments and fuel businesses to address the barriers to supply. At the Commonwealth level, we've been working with the NFF and coordinating directly with Minister Bowen and Minister Collins, both them and their departments on the continual basis. Our focus has been ensuring that agriculture's needs around fuel are well understood and that this agriculture is positioned as a critical industry as this crisis progresses. On fertiliser, it's a very complicated issue and we've been working through it on a continual basis. So acknowledge that our understanding of potential shortages are still emerging and we've got a better understanding in fuel than we do in the fertiliser space. So there are multiple fertiliser inputs used in Australia and they come from multiple countries. So at the New South Wales level, we've been working with the New South Wales Department, seeking to understand what the specific barriers for fertiliser are and how we get them into the regions. At the Commonwealth level, again, we've been working with the NFF and there's been the announcement of the National Food Supply Chain Assessment that will look at supply chain vulnerabilities for fertilisers after looking at fuel. And we've been continuing contact with the ACCC to be monitoring prices and supplies. It's also important that the horticulture industry is experiencing fertiliser shortages as well. So we've been talking with AusVeg on grower shortage data and retail supply stock levels. The government has also established the Fertiliser Task Force. We've also been calling for urgent FERT-specific supply chain analysis and calling for a national coordination of these important inputs that are coming through imports. But we do need your support. Our farmers have been fantastic at sending through their case studies, and it's one of the primary reasons that government now has a better understanding about the impact that it is having on your business. But we need this to keep coming through, both in relation to fuel and fertiliser. As soon as we start to become silent, government will think that the issues have been addressed. So please keep sending your case studies through. I'll put up a slide at the end of this to where you send them, but we want to know what shortages you are experiencing, what's the pricing situation, and if you're making any decisions now that might impact what production looks like later in the year. Now I'd like to introduce our expert speaker for today, Andrew Whitelaw, founder and director of Episode3. Andrew grew up in the UK, where he cut his teeth in the animal feed and biofuels industry before making the move to Australia in 2010. He holds a degree in business IT from the University of Western Scotland and a master's in agribusiness from the University of Queensland. But it's hands-on experience that really sets Andrew apart. He's worked across agriculture and the food sector and has even co-owned a pig farm. So when he talks about what farmers are facing, he talks from real experience. Outside his work, he's also a co-host of Agwatchers, a popular podcast that he co-hosts with Matt Dalglish, where they dig into the big issues facing agriculture, which this crisis is clearly one of them. When he's not doing that, you'll find him very busy on the sporting field. So whether it's in the ice hockey rink or on a mat training in Brazilian jiu-jitsu or wrestling and boxing. So Andrew, over to you.
Thank you very much for having me on. And thanks to everyone else who's taken the time out to actually come on board. I didn't realize it was 2010. That was 15 years ago. That makes me feel even older than I felt when I turned 40. But we will just get into it, and we'll talk about the situation. I'm going to talk about fuel, fertilizer, and grains because that's the predominant areas that we think are at risk. So there will be slides in here which do seem to be pretty obvious, but I just want to highlight what we do at episode3.net. Our job is basically to provide market intelligence independently and objectively. So we don't buy or sell anything. We just basically provide information. So we spend all of our time looking at markets. And I want to just point out this last thing here is we're not really here to tell you what you want to hear. I'd love to be able to tell you some loads of positive news. Unfortunately, we have to be independent and objective. So sometimes we've got to tell you what you need to hear and not necessarily what you want to hear. And that's what we think is very important. So I'm going to start off with talking about fuel, and obviously things are changing at a rapid pace. You know, these slides, you have to change them. By the time this webinar is over, all these slides might be out of date, to be fair. But the reality is that it's a changeable situation. It's a volatile situation. And we'll talk a bit about the ceasefire later on, because that's obviously just a new event. But again, looking at crude oil, just put up this chart just now because this is the crude oil price at the moment, and I'm just really looking at this real end peak here where we had peaked on the market basically yesterday when Trump was saying that he was going to destroy their civilization. Since the ceasefire came around, markets at the point of making this chart, which was about 9:30 this morning, markets had dropped about 14%, but they're now about 18 to 20% down in terms of crude oil, but also gasoline and natural gas. Basically, the whole energy complex is down. Again, we're talking about locally, our diesel price has gone absolutely bonkers. It's gone through the roof, as we can see here. And these are record and sort of unprecedented times for diesel. But I would point out that we have actually been in what is probably a bit more of an inflated pricing period right through from about 2022. And I think that's an important thing to remember, is that our supply chains have changed significantly in the last decade. And it's been all of the news that we don't have huge supplies held within Australia. And that's because our refining capacity has dropped massively. But we are seeing that, you know, I've just narrowed this into just the recent period. That price has dropped a little bit on diesel, but again, we are still massively heavily priced when it comes to diesel in Australia at the terminal gate price. One thing to note is this is a terminal gate price, this is a wholesale price, and I know that you're all paying way more than this. I'm paying way more than this, but this is the average terminal gate price, so basically a wholesale price, for want of a better word. But this is the key one as well, and this is something that we need to think about after this crisis. And this is the diesel to crude oil spread. Crude oil is what we use to make diesel. And we look at this as being a form of what is the spread between, diesel to crude when you change it both into from barrels to cents a litre. And again, if you look back historically from 2004 up until 2022, it sort of ranged about a 70 to 80 cents premium over crude. And we're just looking at it from a relative value point of view. But then refineries closed down, and then we've seen since 2022 onwards, that spread has increased massively. And obviously now it's at a record level where our diesel pricing is heavily much higher than crude oil. That should come back down as energy prices readjust. But this is something that, and frankly, ACCC does have to look at, in my opinion. But again, this is a big issue. We've not actually been massively concerned. We write a lot of articles for a lot of different newspapers, a lot of radio, and diesel's not actually been the top of our concerns for Australia, unless the conflict extended into late April, May, June onwards. The reason being behind that is where we get our diesel from. And I know these countries are all largely in Asia, and a lot of those countries do get their crude oil to refine from the Middle East. But I wasn't necessarily concerned for March, April because of the fact that they had supplies in stock, and so we have been okay in terms of supply. Diesel imports, and this is something that nobody really talked about too much because we just worked on a just-in-time environment. We'd get the diesel when we wanted it, but we've been spending a lot more time looking at diesel over the past 6 weeks. And this really just looks at, what is our seasonality of imports. So the dotted line is the average, but I put in the 2025 line, which is that grey line, and up till the end of March, our 2026. And what we can see is we actually had a really big month in January, which was quite lucky that we imported so much diesel in January, which meant our stockpiles were actually reasonably strong. February was above average, and March is at the sort of what we call the top end of the standard deviation. But if we look at the first quarter in 2025 versus the first quarter of 2026, we have imported substantially more diesel than normally had. And I know there's logistical problems getting it up country, but we had 22% more diesel imported in the first 3 months of this year than we did last year. I think there's a major issue with communications. I think the government hasn't done the best job of keeping people, removing the anxiety from this diesel situation. And a lot of the press has been telling us we're going to run out. But at the moment, we have been fine up to March. And that gets us into tracking what is coming in for April. And at the moment, what are we just now? We're the 8th of April just now. And if we look at 2025 versus what is on the water and on the way to Australia, we're at 88% of last April's volume. And I want to be very clear here, that doesn't mean we're only going to have 88% of last year's volumes. That means we've only booked 88% of last year's volumes. New boats are getting added every day pretty much, and it seems to me that they're increasing the flows compared to what they would typically do. And what is making it really interesting is we're still purchasing most of our diesel from the same places, largely in Southeast Asia. But we have had a few unusual ones. We've had a couple of boats from the United States, but we've also had a boat coming from the United Kingdom, which is currently just to the west of South Africa, and it'll be here by the end of the month, which is, I think, probably the first time that has happened in at least a long time that we've actually brought diesel in from the United Kingdom. And from my point of view, I was in the UK last week on holiday, and I was surprised for the first time ever to actually find that fuel was cheaper in the UK than it is in Australia. Typically, it's substantially more expensive. One of the other things that we hear a lot about, and I think it is important, is about biofuels. And there is a push for biofuels in Australia. But what I want to highlight is it's not the panacea. I think we need biofuels in Australia, not necessarily for fuel security, but just to create a market so our farmers can actually make more money. Because if we have a domestic market for all of our canola, it would be far more profitable than just sending it to Europe for them to make biodiesel. But it wouldn't fix all the problems. And so this chart here basically looks at if you took all of the canola we produce in Australia, and then instead of exporting it, we converted it into diesel. This is how much of our diesel demand would be met. So at its maximum, in our best year, our record year production, we got just shy of 9% of our diesel demand could be met from canola. But it goes down as low as 1.5%. So it's not necessarily the panacea for our problems, but I do think it's a good market that we should be heading down, but for the right reasons, which is making money. And again, that was using 100%, but if we sort of said, well, how much fuel could we meet if we had, 50% of our surplus grains was used for petrol production, like for using our wheat, our barley, everything else, which is unachievable. Maybe 5-10% is, but it still equates to less than 5% on average would be how much of our fuel would be met by biofuel. So again, great market for us as an industry, great market for Australian farmers, but it isn't going to save us from these type of issues. So that's really the fuel one. It's pretty self-explanatory, and I'm pretty sure everyone knew most of that anyway. The good thing is I'm sort of confident that we're fine up until the end of April. The ceasefire is here, so there'll be more boats moving. So hopefully that should allow us a bit of comfort into May and June. So touch wood, fingers crossed, and any other sort of superstitions that you have. So the one that we are most concerned about is urea. And again, I said at the start, I'm here to tell you what you need to know, not what you want to hear. And unfortunately, it's not a lot of good news from this point in, really. Why it's such a big issue, this conflict in the Middle East, and as soon as you have a conflict in the Middle East, it has an impact on our urea. As we can see here, this looks at our annual basis where we've imported our urea from. You can see in the teal line, about 70% of our urea will come from the Middle East, then about the rest of it largely comes from Asia, with a very, very almost imperceptible volume coming from the rest of the world. So whilst we don't actually buy any urea from Iran, the conflict has escalated to other regions like Qatar, which has meant that they've shut down their plants, and that is largely the problem. Is they're a huge producer of urea. It's no longer available, so everyone is chasing down the same volumes. So large parts of the world are obviously trying to buy from Asia or from the US or Europe, which is pushing up demand from a smaller supply base. Again, we can skip this one, but basically this just shows, again, the average, what we've had over the last 5 years, but again, massively overwhelmingly focused towards the Middle East. Again, we're at the end of March, and it always takes a bit of time to get that import data on fertilizer, because the government usually has about a 2-month lag before releasing it. But I just thought, well, how much would we typically, because normally we work on averages, history works on averages generally. And so I thought, well, how much have we got in to the country, or how much could we have got into the country by the end of March, because ships would have already left at the start of March before this conflict erupted. But we're looking at sort of potentially that 16 to 20% of our season's urea requirements could be in Australia or on its way to Australia. That's good. That's what we would typically expect by this time of the year. But the key thing is the next basically 4 months. So this looks at the seasonality of imports of urea on a monthly basis. And you can see that middle line, that average line. Basically, June is where we get the bulk of our imports, but April, May are big months of imports. And so that's the real concern we've got, is what happens if it doesn't come in time for that sort of top dressing period. So we've said from the start, the longer the conflict goes on, the worse. And whilst we've got a 2-week ceasefire, there are stocks of urea on the ground in the Middle East that can be loaded onto a boat straight away. But restarting those facilities, that is a 2-week job. So this is the key period, the next basically 3 months, about how much we get into the country. We track pricing. This is just basically to show you, this is our monthly modeled urea price. This looks at how much it costs to buy urea from the rest of the world and import it to Australia. It's a monthly average, but what I'm only putting this here basically is to show is we then track it against what the government's import values are, which is the green line. So we know that our model works in terms of getting a fair price landed Australia. And that's where this comes into it. This is us looking at urea pricing on a weekly basis. And as you can see, I've highlighted the first year of the Ukraine war, because the Ukrainian war caused gas prices to spike dramatically. And then we had last year, we actually had last June, we had a big spike in urea pricing because Israel and US did a small scale attack on Iran, which caused prices to go from, as you can see, $700 a ton to over $900 a ton in a short period of time. This conflict is a lot bigger than that conflict, and now we're having prices actually exceed the levels during the first year of the Ukrainian war. So again, these are prices that, you know, are kind of they are astronomical, and it's making decision making that much harder. So we just saw basically this week, it's our landed price model shows about just shy of 1,500 Aussie dollars a ton. Again, that is landed, that's at the port, and that's without margins, etc. on top. Again, but so clearly, very difficult time. However, this looks back, and bear in mind this is US dollars a ton, and this is up to the sort of middle of March, so it's not when we had the peaks, but this takes into account inflation. We actually had higher prices when we account inflation back in the 1970s. That was when the peak pricing was. So I guess that is one bit of good news somehow, that we're not the worst pricing of all time, but we may well get close to that. And the reason why we've looked back at the previous periods of time is to look at, well, how long might it last? How long might urea prices remain heavy? And so basically, if you look back on that previous chart, we had basically 4 periods where the price spiked really dramatically. And what we've looked at, we've indexed it all back to 100, and we've basically looked at how long, once prices remain high or get high, how long do they stay high for? And generally, it's about that sort of 19 months or so, unless you had that 1977 to 81 energy crisis era, where it lasted about 5 years. Touch wood, this is all over soon, and the ceasefire holds, and then we can get back to more of a GFC type 1 year, or Ukrainian sort of, you know, less than 2 years peak. So this is it in terms of months. So this is the number of months in those peak periods where the prices remained above the 75th percentile. So again, I would like it to be over in less than 20 months. I was back to sort of a more normal level. But again, it all depends on how badly infrastructure has been damaged and how quickly we can get a true resolution, not just a 2-week ceasefire. Oops. So as we mentioned before, we're tracking the diesel that's coming into Australia. We've started a project, or we've been working on a project in the background, doing very similar, but tracking not diesel. Fertilizer coming into Australia. It's a little bit more complex because of the fact that the way fertilizer is shipped is obviously shipped in bulk cargoes, and it doesn't always tell you what is on the boat, but we can use a bit of logic to work out what is on the vessel based on where it's coming from and where it's going to. But we are seeing some volumes coming in. And if you look back to that chart I put up previously, we were talking about 70% of our fertilizer, or urea in this case, coming from the Middle East. In this case, if we're looking at what's coming in the next sort of fortnight to 3 weeks, there's only one boat coming from the Middle East. The rest of it's coming from Brunei or Indonesia, but it's about 200,000 tons, which is kind of on the level of what we would expect for this time of the year. We've just got to hope that we continue to get boats. But this is not, again, this is a prototype. It's not necessarily 100% of all the boats coming in. There may be other boats, but we're still working on this in the background in order to make sure that there is that transparency on the industry. We think this will be pretty valuable, not just this year during the crisis to sort of relieve a bit of anxiety, but what in the future it will allow us to keep a track of what is coming in, so we'll know if there's a real shortage or not, and we'll also know how much stock is in the country to an extent. There is, and I just put this in last minute because, and I know that in New South Wales, this has probably not been so much of a big issue, but I know this webinar is open to people throughout the country, and in Western Australia, it has been a big issue, is force majeure. Force majeure is actually quite a rare occurrence in commodity markets and really hard to actually enforce. But basically, force majeure allows a counterparty in a contract not to walk away from a contract, but to delay delivery of a contract. But it should only really apply when it's prevented. So it's still up to the seller, in this case, in the fertilizer, to prove that they couldn't buy it from elsewhere. And it's not just a case of them saying, it's too expensive for us to buy from the Gulf of Mexico. That's not your problem as the buyer. That's their problem as the seller. So they have to attempt to source elsewhere, even if it costs them more money. And again, I just want to highlight really importantly, if your fertilizer supplier says you're not getting your fertilizer or you're only getting X percentage of it, double check your contract. And I recommend to everyone, I know a lot of people get verbal contracts, is get a contract, a written contract in future if you don't already have one, just so you know your rights. The same is what you should be doing with your grain contracts, but just be very mindful, especially those in Western Australia. So the grains, and I think this is it's a key point about what we're all here. Most of us are grain producers, I imagine, on this webinar. We're paying expensive inputs. We hope for expensive outputs. We hope that the market rises to meet. During that Ukraine crisis, we had really strong prices for fertilizer, but at the same time, we also had really good production in Australia, so record production levels. So we had the volume, but we also had the Goldilocks sort of zone of excellent prices at the same time. But let's look at what we're in just now. And I just want to use this, and if there's any grain traders in the room, I've put as a general rule, but generally the grain trade and grain buyers in general, they don't really care too much about your cost of production. They care about buying it at the cheapest cost. That's the reality. If your cost of production goes up, for instance, if fertilizer in Australia was $1,500 a ton, but elsewhere it's $800 a ton, that's not their problem. They don't really care. Like, it should, and we think it does, but the reality is we get the price that we pay, whether we get for selling our grain, but the reality is that just because cost of production goes up doesn't mean the grain trade will be saying, okay, well, we better sling you a bit more cash because it's been a tough year. This is what should have happened, but the conflict hasn't really gone on long enough, and that's probably one of the risks of this ceasefire. We all want peace, but the risk are that this early ceasefire is that it doesn't have enough disruption on energy. So this chart looks back basically it's an index looking at crude oil price and the wheat price going back to 2003. And what we can see in this is that the markets tend to follow one another with a really close sort of correlation. It's not just correlation, it is causation. Producing a crop takes a lot of energy, but also a lot of our grains and a lot of our oilseeds are actually used for biofuels, as we sort of mentioned before. Maybe not so much in Australia, but around the world, huge volume is used for biofuels. So if the energy market goes up, demand for energy goes up, but at the same time, the demand for biofuels as a replacement goes up. So we tend to see biofuel prices rising. But what we can see in this chart is that crude oil has gone up significantly in the last month, as we all know, but the grain price hasn't. So in previous times, we've seen the market has followed. I think it's not followed closely enough because the conflict hasn't been on long enough, and a few other stock issues which I'll go into. But if we look at canola, it's very much the same picture as well. As energy markets rise, so do canola markets and oilseeds. And I put this up on Twitter this morning, and I got told it was the most depressing chart that they'd ever seen in their life. And this looks at the conflict and what the reaction has been to prices. So I've basically taken week one, so you'll see week one, and it's a bit, maybe a bit hard to see, but week one is the third bar along on each of these commodities. And I've looked at 2 weeks prior to the conflict up until 20 minutes before we came on this webinar. What we can see is that urea, diesel, crude have all risen massively since the start of the conflict. They actually rose significantly just even in the last sort of 2 weeks or so. Crude oil has also risen. But again, these are all rebased as indexes, but we were seeing that those markets for our inputs have gone up massively. But on the flip side, I'm just taking ICE canola and CBOT wheat because it's quite a generic indicator and it represents most of our pricing anyway. They've hardly moved. The dial has hardly moved on our output prices. So that is my biggest concern, is the timing mismatch. And this is something we've been talking about since the start of this conflict, is that we're paying for all these high inputs, but we will probably not sell the majority of our crop until December. And that is a timing mismatch. And this is where we're sitting at the moment, is a lot of the grain trade just doesn't have the fear of missing out at the moment. At times during the conflict, the market has followed energy, but then it's rallied a little bit, but then lost most of its momentum. But if we look at things like the global oilseed stocks, we're sitting on heavy stocks around the world. We're very strong stocks, in fact, record stocks. And this looks at all oilseeds. If we look at wheat stocks, last year was a surprisingly good year for Australia, despite having drought in Victoria and South Australia. But on a global level, we also had record crops in many parts of the world. So if we look at these green bars, that is the world stocks of wheat, which are the highest since 2020. But what we feel is more important is the amount of stocks within the exporting nations, and that's where the little dots are, and they are the highest since 2017, 2018. So that means there's a lot more available to export around the world. So traders have been looking at that and saying, well, we're not too concerned about missing out for this year. And that's why we're seeing a bit more action into sort of next year's crop. Again, this is the key concern that I've got, is there is almost no correlation between the price of grain at seeding and the price of grain at harvest. You can have years where the price goes massively through the roof, and you can have years where it falls by harvest. So that is the key thing that you've got to talk about when you're discussing it with all your advisors, whether it's your accountant, your bank manager, or your agronomist. And a good example of that is probably that Ukraine crisis. So here we've got the wheat price and urea price. So we've got the wheat price at seeding and at harvest, where we had, a stronger wheat price, and this is US dollars a ton as well. But we had wheat prices very strong at seeding, and then they fell by the time harvest came. But also at seeding, we had really strong urea pricing, and by the time harvest had come, urea prices had dropped as well. So it's just that timing mismatch, which I think is my biggest concern for producers in Australia is we've we've paid out for a lot of expensive inputs, but there's no guarantee that we will be able to recoup all of that come harvest, and that's before we even think about the weather. So it's really that was a very sort of short summary of what we're seeing in the market and what we think people should be prepared for this year. And I apologize for it not being good news. I'd love it to be able to give some good news, and hopefully one day I can, but unfortunately that is not the way the market works at the moment. So I think we've got some questions.
Yeah, absolutely. And Andrew, you certainly lived up to your billing that you weren't here to deliver good news, but these are informative sessions because we want people to understand the situation that is evolving constantly. And I wanted to start with, the announcement that's obviously happened this morning with the ceasefire and opening up the Strait of Hormuz. So in the 20 minutes after Trump's announcement, you've already talked through the drop in the crude oil price. It won't translate to petrol prices immediately, but it is expected to bring some relief for motorists. What relief can farmers expect with their diesel prices?
Look, I think we will. It flows through. It always does flow through. We tend to have a term in economics called sticky pricing, where the price tends to rise pretty quickly, but it tends to fall a little bit slower. It's sticky, like treacle, and that's what I think we'll see. I think they may reflect it a little bit quicker because I think there's a lot of eyes on the fuel industry at the moment, including the ACCC and every media watchdog out there. So I think it will start to flow through. I'm not convinced that the ceasefire will necessarily hold for particularly long because the ceasefire seems to be Iran and the USA, and we're already hearing about Iran attacking Israeli sites and Israel continue to attack Iran. So whether Iran sticks up to its bargain and vice versa is pretty much the concern that we have at the moment. But it should flow through eventually. And I think the fact that we've already got 88% of our diesel on its way here, that's obviously priced probably at higher levels. So it will take time for it to flow through, and it all depends on how those energy companies have hedged their purchases. So, but on fertilizer, I think it's not an overnight change, and we've been saying from the start, don't be chasing the market thinking that you can play it and hoping for lower prices. It's with diesel, we believe it's a price issue, not a supply issue. With urea, it's a price issue, but also a supply issue. So don't wait too long would be my guess, and don't expect price falls in the next couple of months, or not significant ones at least.
Thanks, Andrew. And this is a question from David. So, the outlook looks challenging because of the fragile state of the global environment, and Trump really is redefining, his approach to diplomacy. So, how do farmers deal with this, and how do we react in the strategy to remain with a clear strategy to remain viable?
Sorry, I missed that one. Can you just start again? Sorry.
Yeah, absolutely. So, we've talked about how challenging the global environment is looking. Trump's diplomacy is sort of reworking the way that global trade, global economy has been playing out for such a long period of time. So how do farmers deal with this, and how do they react with a clear strategy to remain viable?
Yeah, Trump's diplomacy. Diplomacy is a good word for it, I guess. No, I think it's very much an uncertain time, and it seems like it's the most uncertain time that we've been through. But on this call, we've probably all been through the GFC, we've been through COVID, we've been through Ukraine crisis. I think what we sort of, as globally, I think there's a lot less reliance on the US as a trading partner, because we don't know if we're going to get tariffs today or tomorrow. And I think, there's not much an individual farmer can do other than it's a bit like on the roller coaster. You're you're latched in and you just got to hold on until it gets over. But I think that's where organisations like New South Wales Farmers and your state-based alternatives in other states, plus the National Farmers Federation, it's about making sure that we actually get as many doors open as possible. We want to make sure that there are trade deals with, like I know the EU trade deal was not necessarily popular within the ag sector. It's probably not a good example, but we need good trade deals with as many partners as possible so that we can, we're not as reliant on sort of one nation or one sort of area, because our diversification both in what we bring into the country and what we send out the country is quite lacking in several commodities. Barley and sorghum are prime examples of that.
And we've got a question from Nick, who's really calling out that this crisis is exposing some of the weaknesses that we do have in our supply chains and how reliant we are from imports, critical imports. So the question is, do we think that onshore fertiliser manufacturing over the next 5 to 10 years, is that the approach, and is that a better way of, getting rid of some of these price spikes that when we are at the mercy of the global markets?
Look, timing-wise, this has not been a great sort of conflict. If this was happening in sort of end of next year, we might be looking at it in a slightly sort of different situation. So there is a facility up in the north of Western Australia that's got government money. It's in the production phase or construction phase, sorry, and it will go into production phase, I believe, in June next year. But there's potential for it becoming on earlier. That will produce, I think, 2.3 million tons. There's an offtake agreement with Macquarie for, I think, 1 million tons. A lot of that will go onto the domestic market. And at the end of the day, those facilities are private entities. They're not government owned. They will be priced at the global market level. If the urea price goes to $2,000 a ton, why would we expect them to be selling it for less than $2,000 a ton? They're not charities at the end of the day. But it does provide one thing, which is a potential security of supply. And bearing in mind, they will be selling it to all over the world. They'll be selling it to who can buy it, same as any other trading company. But having 2.3 million, 2.5 million tons of production within Australia does mean that there is a localized production which we could potentially call upon. And I don't know, in the future, if something's even worse than this, we could potentially be looking at things like export bans, which we do see in parts of the world like China. Maybe the Australian government says, well, this is a significant resource that we need to keep in Australia. But I think definitely it is not necessarily about lowering prices, Nick. It's more about security of supply or potential security of supply. And there's other facilities that have been, suggested, and there's Lee Creek, there was one in Geraldton, but they don't seem to have got beyond the construction stage. So helpful, but not necessarily for price.
And we've got a question, and I saw this on your socials as well, sort of around, India's put in a big order. So is that, sorry, I've just lost the question. So surely that's implying that there is plenty of urea out there available. So is it more just, getting that supply, but recognising it's a highly competitive market at the moment?
Look, again, India put out their tender, so 2.5 million, which they put out tenders every couple of months or so, but it's a big tender. It's also a big tender at a time when price is extremely high. And whilst, yes, there is supply all over the world, and we've been buying a lot from the Middle East, and India has been buying it from, same as us probably, cheapest available source at the time. But again, it's 2.5 million tons of demand coming onto the market at a time when we do have, constrained supply. There is less supply regardless. And the good thing is that we are pivoting away. There's various companies looking at purchasing more from Asia, whether it's Indonesia, Brunei, or various other countries. But I think that is the key thing. It's like there is still urea out there. So, and again, it comes back to that force majeure discussion I was having. If a company says they can't supply it because they can't import it because they purchase it from the Middle East and they're not getting access to supply because of war and disruption, it's still available elsewhere in the world for them to buy. It's a bit like if you're a farmer in New South Wales, you sell your canola for this coming harvest, but then you don't produce it because you get a frost. You're still expected to supply that canola, either supply it from a neighbor or someone else, or you're expected to pay the difference. So I think that's a good point that Philip's made there.
And we have got a question around force majeure. So, it's been called by the two WA companies, partly because of the halt in ammonia coming out of the Yarra Pilbara. Can we expect something similar in the east?
Look, I can't comment too closely on that individual sort of circumstance, and there's a lot of discussion at the moment about the way that those contracts are, the force majeure is actually declared in those contracts, where, and I haven't seen a contract to hand, but I've been told that some of their contracts do include price as a force majeure clause, which is highly unusual. And UAN tends to be a lot more popular in the West than it is the East Coast. But I can't really answer any more on that one, unfortunately. I just don't have any details.
Nope. So just pivoting, you made the point about the lack of correlation between high inputs and grain prices. Have you got a 12-month grain price prediction?
Oh, goodness. In terms of the next 12 months, look, we're sort of hovering around about that sort of, the prices have been pretty low from last harvest, and they haven't really peaked up all that much in the last sort of 3-4 months. And if we look back at that chart, we were up a couple of percent. We've got a period now where I think a lot of farmers will be looking at, well, what they plant. And we are hearing of a lot of farmers deciding that, $13, $14, $1,500 urea just isn't viable at the current prices. But at the same time, we are sitting on pretty big stockpiles of grain around the world. So I think I wouldn't be surprised to see, I'd like to see prices rise. And if we look at the forward curve, and if we look at prices on offer for next season, they are higher than old crop, which again signals that the psychology of the market is that they're not necessarily concerned about getting access to grain just now, but they are concerned about it for next season. And bearing in mind, we haven't talked about weather. And whilst that is still going to be the biggest driver of whether we're profitable or not, is whether it rains and how much it does rain. So I think it's fence sitting. I think if we looked for 12 months' time, I'd say we'd have higher prices, but not at a high enough level that will be like, wow, who cares about the price of urea? We've made so much money from our grain price. But that being said, if we had a year like 2022, where our production was massively record, and then prices rose significantly, then we could be at least alleviate some of those costs. But I think it's a cost price squeeze is our biggest concern at the moment. So to sum it up, price is higher. I don't know by how much, but I think stronger pricing.
And Andrew, have you got any outlook on other fertilizers such as phosphorus or potassium?
Well, I think those markets have not really sort of driven up quite as highly, and we haven't really been focusing too much on them. Even if we talk to Fertiliser Australia, the reality is most of our requirements were in the country or on the way because they're required for seeding. So we haven't really seen too many major issues in them as far as we're concerned.
Yep. And question from Sarah is, do you know the pulse stocks, what they're like globally?
Pulse stocks, as in lentils and well, this is actually I didn't actually sort of cover this one because I wanted to actually be sort of remove something that's negative from the presentation. is that is a concern that we've got as well, is there's a lot of people talking about increasing their lentil production. And I'll just use that as an example. I spent a lot of time in sort of middle of last year and towards the start of this year. Prior to this conflict, this was a concern of mine, is that there's a lot of farmers deciding that they want to grow lentils in areas that traditionally hadn't necessarily grown lentils, for instance, parts of Western Australia. And a lot of the reason behind that was that it's a new crop to grow, nitrogen fixing, but also highly priced. But the problem we've got is that it doesn't take much to oversupply, and I'll just use lentils as an example. It doesn't take much to oversupply the lentil market. And if we look at it from last year, Australia produced a pretty big crop of lentils, so did Canada, and they pretty much produced more than the average import volume globally, or what the export market was. So we're sitting on pretty strong stocks left over from last year. I don't have a number on it, but it's strong. And at the same time, I think we're going to see more numbers in the ground, whether it's in Canada or in Australia, which again, we've seen lentil prices, $1,000 a ton, and then now I think they're between $500 and $600 a ton, and that's because of the supply. And if we produce way too much, we can easily oversupply that quite quickly. So that is a concern about putting too much in the ground in terms of policies. But again, they're a way to prepare for next year, because I think fertilizer prices are likely to be expensive next year as well.
Yeah, you had that graph showing that unfortunately these aren't sort of, they rise, but the decreases can take some time before they come back through. So pivoting over to fuel, Andrew, how much fuel in total can Australia store on land at any one time?
Oh, geez, well, that's a good question. It's a tough question because I think, we were restoring 36 days was our record storage, since 2010. And this is where I think this is the opportunity, and this is a suggestion for you guys, New South Wales Farmers and the NFF, is we could aim to store 90 days as part of our requirements, but that's going to cost us billions of dollars to do that. But it's also, in my opinion, and I look at it from a point of view of strategy, we can store all that, but it's likely if we do that in a centralized way, it's going to be stored in Sydney, Brisbane, Melbourne, Adelaide, the big cities, yeah? What we should be looking at is the potential for some sort of tax incentive for farmers to put larger scale storage distributed throughout the country, because let's be honest, we're in a geopolitically turbulent time, and if there was a war, Sydney, Melbourne, Adelaide, Perth, there's only a couple of cities on the coast, and you could take out all that oil infrastructure in about 10 minutes. Whereas if it's distributed across farms, maybe there's some sort of tax incentive or something for encouraging storage on farm. Same with fertilizer, same with what we do with hay to support ourselves for drought. But in terms of how much we can store, I've got no idea. But it's expensive to store, and I guess no government has really been particularly good regardless of what side of politics. Nobody's stored all that much.
No, it's an important one to look at, and I think a lot of these questions are being asked now. And there was a question from Nick again. What are you telling farmers that they want to see with regards to government action to protect farmers from future fertilizer price shocks? I think you can put fuel price shocks in there as well.
Yeah, well, I guess it could be anything. It could be livestock farmers with hay. I think it's about being strategic, and I think, if we look back at that long-term price of fertilizer, we're really only talking, we're in the fifth large-scale peak. We've generally just plod along, and we don't really think too much about it. It's only when it peaks that we actually think about it. Unfortunately, it's just not that long since the previous peak with the COVID/Ukraine sort of crisis. So I think farmers are now looking at storage on farm, putting in proper sheds that can store urea. But at the end of the day, I think we should be looking at more transparency across the industry. We won't, like we've been calling for it for the best part of a decade. Transparency on pricing, transparency of stocks, transparency of imports. We've been doing, we're a two-person team, but we've been trying our best to shine a light on it a little bit. Uh, but I think there's options around sort of price risk management tools, storage in advance, uh, and I think a lot of people now are sort of wary of the just in time, of waiting till 4 weeks before seeding to purchase their fertilizer and their fuel. So I think we will see a bit of a change in behaviours over the next sort of couple of years. But in reality, if we get peace and we'll go back to normal and we'll get used to just in time because that's the cheapest way of doing it. Because we can store as much as we want, but who wants to pay for it? Like I've heard people talking about, we're going to put fertilizer storage in and store our fertilizers. Like, well, do you really want to store fertilizer at $1,500 a ton? Yeah, you want to store it at $500 a ton, but it all costs money, and somebody has to pony up for that.
Yeah, no, absolutely. It's a really good one, and one we're talking a lot about internally at New South Wales Farmers as well. And I think there's going to be a lot of lessons to come out of this, but also our focus in terms of the advocacy is ensuring it's on the immediate crisis and what needs to be done there. Because as soon as we start talking longer term, government is going to think the short term impacts have gone away. So it's that fine balance. And Andrew, we've had so many questions come through, and I'm really sorry we're not going to be able to work through them all. So the final one is, have there been any numbers done on the amount of urea that we might be missing? So for the winter crop, but say if this does continue, what does that sort of look like for summer?
Look, that's the sort of the big question, and so I think everyone's been asking that. We've got no real handle on it because again, we don't know when it's going to end. Like I think I saw in the questions, Graham Sandrell's put up a point there about 2 weeks to get facilities back on, a couple of days to load, X number of days to get it here. So that gets us into sort of May at best. But if this conflict goes back to being a hot conflict again, it's anyone's guess, I guess. And the fertilizer industry, when they've been interviewed by the media, so Fertilizers Australia, they don't have a handle on it. So I don't know how anyone can have a handle on it. But I think it's definitely one of these years where you've got to not act as normal. Speak to your advisors, speak to your agronomists, and I think GRDC is putting out some pretty good stuff in terms of, again, webinars, but more suited towards agronomy. But basically make those decisions appropriately is what to do. But in terms of numbers, I'd love to know how much we're missing, and hopefully it's not much, but err on the side of caution this year, I think.
Okay. Well, Andrew, thank you so much for your time, and thank you everyone for the questions. Unfortunately, it's time to wrap up. I did want to highlight again the advocacy that agriculture has been able to achieve, and ensuring that the needs of farmers are well understood has been driven by the grassroots, by farmers sending through their stories about the impacts that the fuel and fertiliser shortage is having on them. So please keep those stories coming through. There's a slide up there on where to send them through to the Commonwealth Department. Please keep us in the loop as well, because we are also sending it through to the New South Wales government. So send that information through. And just the final reminder before we head off is please complete our survey. As I said, this is at the beginning, this is a series that we have been doing on the crisis. So we want to know what you need. What is the information that you'd like to hear further, so that you can make informed decisions in this very challenging and changeable environment. But thank you all. Thank you, Andrew, and we'll see you next time.
Thanks for having me.